Hello and welcome to our second session on DS Sparks. I am Furkan Mohorkan, Senior Correspondent with Decade Herald. So, DS Sparks is a new webinar series focusing on different topics and deliberated upon various experts. Today, we are looking at what it takes to make the right investment decision in these uncertain times what we are facing right now. To help you make these decisions, we have a reputed panel with us. Today's panel will be moderated by Hansi Mehrotra. Hansi is the founder of Money Hans, a personal finance platform. Hansi has more than 20 years of experience in financial services, mostly setting up online tools for investment research and consulting for the wealth management industry. Over to you, Hansi.
Thank you, Furkan. Thank you very much. Hello and welcome to everyone attending this, and also obviously to my esteemed panel. Thank you very much for making the time. So before we get started, I will introduce the panel, and I'm reading out, so pardon my glasses. I am happy to welcome Nilesh Shah. He's the Managing Director of Kotak Mahindra Asset Management. He has over 25 years experience in capital markets and market-related investments. Nilesh, is it exactly 25, or so you also rounding it off? After 20, I rounded off. I don't mention that it's 27, but is it?
No, it's now almost 3 decades without counting overtime.
Okay, fine, cool. So it's 30 odd years. Like I said, I'm not going to mention exactly mine. In his previous assignments, Nilesh has held leadership roles at Access Capital, ICICI Prudential, Franklin Templeton, and ICICI Securities. Nilesh is also the chair of the Association of Mutual Funds in India, AMFI, and he's also on the Prime Minister's Economic Advisory Committee. Welcome, Nilesh.
Thank you.
I would like to now welcome Anubhav Srivastava. He's the partner at Infinity Alternatives. He also has over 20 odd years experience in the financial services industry. Previously, he was the head of the passive business at a leading asset manager and has over the years developed expertise in ETFs, modeling, risk management, and analytics, leading to new benchmarks and innovative products. He was responsible for the most shares NASDAQ 100 ETF. He advises regulators on systemic risk management in addition to regularly commenting on the larger investment in ETF space. He holds an MSc in Quant Finance and MBA from IIM Ahmedabad. Welcome, Anubhav.
Thank you.
And last but not least, welcome to Pratik Oswal. He's currently the MD and CEO of Motilal Oswal Asset Management's passive business. Prior to this, he was heading operations and finance at a Series A fintech startup, Stratify Technologies, in San Francisco, California. The company was backed by prominent investors such as Y Combinator, Khosla Ventures, Anthemis, and many others. It provided automated wealth solutions to investment advisors managing over 400 million in assets. Pratik is passionate about product management, fintech, and cares about customer education and simplifying finance. Apart from fintech, Pratik has experience working in investment banking, private equity, and also options arbitrage. He studied math and economics and has an MBA from London Business School. Welcome, Pratik.
Thanks, Nancy.
Okay, so let's get started. Now, as the session is on personal finance, and Furkan said that my background is also investments, but a long time ago, and I, like you, Pratik, was advising a whole bunch of wealth managers across Asia Pacific. And I realized that before investments, you really have to put your overall personal finance in place. And so sometimes when people jump into talking about investments and haven't got their other matters sorted out, that's probably not a good idea. So a long time ago, I realized that the best way to do this is to have a mental framework. As Charlie Munger calls it, a mental framework is basically a lattice work of ideas so that you can put things together. The way I thought about it is to divide my personal assets, wealth, into 3 buckets. Don't lose me my money bucket, which is basically things like your own house, emergency cash, and insurance, and maybe a bit of gold. The second bucket that I invest is my long-term wealth creation bucket. That I put all of it in equities, 100% equities, in fact, Asian equities. So sitting in Australia, I was betting on basically the high growth sort of markets. And the third bucket is what I call the aspirational bucket, or fun money. So that's where I do my hobbies or high risk, high return investments, my business, anything that has what in finance we call idiosyncratic risk, or in layman's term, just high risk, high return. So that's the 3 buckets. And if and when I want to retire, and I did about 10 years ago, I took some money from these buckets and I put it into an income bucket, which makes sure that my next 3 years worth of income is taken care of without relying on the market. That's how I think about my personal finance. Can I ask each of you to spend 2 minutes explaining how you think about your personal finance and whether you have changed anything during these last 4 months? May I start with you, Nilesh? How do you think about your personal finance?
So pretty much similar to what I recommend others, I also follow. I'm diversified across equities, fixed income, real estate, gold, and offshore assets. I also have taken a voluntary pledge that I will, whenever want to invest in mutual fund, will only invest in Kotak mutual fund scheme. It's like managers eating in the same restaurant. And last 4 months haven't changed anything. In fact, nothing has changed in last 25 years. I have my financial objectives well defined in terms of my daughter's education, daughter's wedding, my retirement, some emergency expenses. And I have tried to cover it through distribution across these 5 primary asset classes between debt, equity, gold, real estate, and offshore assets.
Okay. And just a quick question. I mean, I know you sort of took the pledge about investing in Kotak because you work there. But from a, realistic personal finance point of view, someone who is working in a company and also has ESOPs and also is reinvesting back in that share, that's not very wise, would you not say? I mean,
it is definitely not wise, but sometimes you have to take such decisions, because if I don't have confidence on my mutual fund, why will others have the same confidence?
Okay, fair enough. Thank you.
So, just one clarification. I don't recommend anyone else to invest 100% of their mutual fund investment in Kotak mutual fund. This only I have to do. You don't have to do.
Of course. In fact, in any one mutual fund, we'll talk about that as well, of course. And you've not changed anything in the last few months. Okay. Anubhav, how do you think about personal finance?
Well, again, because of the time that we're in, this might take on a little more significance than maybe earlier. But the first thing I do is take care of my next 6 months of expenses. Just take that out, put it aside. It could be invested in some overnight funds or FDs or any of those things. This is readily available money that is not at risk. Neither price risk, nor credit risk, nor market risk. Other bits of it is all long-term money. Now that long-term money again gets divided into, well, broadly 3 buckets. First is an alternative bucket, which is your unlisted non-mark-to-market space. The second bucket is your core satellite, all that kind of portfolio, which is all your listed space. And the third bucket is your philanthropic space, which is the money that you put into good causes. Now, all of these things need to be managed differently. The alternative buckets is your long-term bucket. Now, in alternatives, I would include real assets and real estate, but not the consumption real estate that I have, that I live in. That's different. But everything else that is an investment, whether it is venture capital, whether it is angel investing, real assets, or anything else in that space, including hard commodities that you hold, is in that bucket. In terms of your traditional investment space, I would again divide my my monies into core portfolio, which is your extremely long-term portfolio. That is essentially what I will retire on. Then I have an alpha portfolio, which is handed over to managers that would essentially give me a superior to market return, well, significantly superior. We'll get into whether that's working out or not. And the third bit of it is a little bit of a tactical investment, which takes advantage of opportunistic investments that are available in the market today with a defined time horizon and a defined exit point, right? So effectively overweighting, I don't know, maybe gold and fixed income today. Somewhere down the line, as the markets bottom out or some such thing happens, I could simply go back into equities, Indian equities. Now, all said and done, everything is largely into the passive space,
right?
Except for the alpha bits.
Okay. And nothing has changed in the last few months?
Well, nothing has changed. Interestingly, notwithstanding the small breakdowns and correlations that we see in gold and the rest of it in the financial markets, the entire asset allocation strategy across my portfolios and my client portfolios has held good so far, to the extent that they're doing actually better than what they were doing in 2019.
Okay, great. Thank you. Pratik?
Yeah. So so basically, so my portfolio is actually something I would not recommend to a lot of investors. So it's a combination of just two funds. One would be just one mutual fund. The entire equity piece is just in one mutual fund. It's been there since I was, I don't know, maybe 15, 16 years old. So I was a big fan of Warren Buffett. Got introduced to him in my teenage years, and I was about 4 to 5 years late. He started investing at 11. So it's been exactly in one fund since that time. I have some money in liquid and also in cash, which I use for obviously day-to-day spending and all that. But it's something which I would not recommend to a lot of people, because I am pretty confident that 90% of people will not be able to be comfortable with the amount of volatility that comes with having just one fund in your portfolio. I'm okay with losing 30-40% on a sort of short-term basis, but obviously being 100% equity is something which is quite risky, but it's worked for me, and I think I'm pretty confident that it'll work for me in the future as well.
Well, the fund, I mean, even my middle bucket, by the way, when I said retirement money, is also in one fund. So I don't have an issue with one fund, but at least there are three buckets, right? In terms of emergency, in terms of equities, whatever. But Pratik, I mean, don't you have your family assets as well? I mean, would you say therefore you're kind of taking that for granted, and that's why you're able to invest in such high risk equities, right?
No, not really. I mean, we keep, at least I keep myself pretty light in terms of expenses. I follow minimalism pretty much. Don't have a lot of expenses. Yes, we do. I do keep some amount of money in liquid and cash to make sure that we have needs or that. But so far, I think last 10 years, we've been 100% equity, and it's been perfectly fine. In fact, we've actually gained a lot in terms of returns. So I do think that is something which has worked for us. Obviously, it's not something I recommend to most people, because it is being pretty aggressive and the volatilities are quite high. But it's something at least I'm comfortable with, and I think if I was okay with the 2008 crash, and also with the crash that happened in February, then I'm okay with whatever's going to happen in the future as well.
Okay. So before we go too much further, we would like to do an audience poll. Can we bring that up, please? Okay, for the benefit of audiences that can't see it on YouTube, for example, I'm going to read out the question. The poll is asking, how confident are you feeling about your personal finance situation? The first answer is, I have lost my job and feeling jittery. Second, I'm hanging on to my job, but still feeling anxious. Third is, business is down, also feeling anxious. Or fourth, I'm feeling pretty confident. So please go ahead and answer that. That would give us a feel for how you're feeling. And then hopefully we can make sure that we answer your concerns. While the poll is still up, just asking the panelists, can I just put the poll down from my screen so I can see you? While the answers are coming up, just out of curiosity, do any of you, all three of you, have personal financial advisors? Like, do you actually go to an advisor and somebody gives you a plan with an efficient frontier and asset allocation and things like that? Nilesh, do you have an advisor?
Yes, I do have an advisor with whom I probably do more of execution, but I do take his advice into consideration.
Right. Okay. And Pratik and Anubhav, you have advisors?
No advisor for me.
You are the advisor.
Yeah.
Right.
Try to be.
Sometimes I don't even listen to myself. So.
Acha, you're not one bhai thing. Kabhi apne aap ko bol diya to main something, right? That's what you said. Okay, so do we have their answers? Are we ready to show? Furkan? Yay, yes, we do. Okay. So 14% are saying they have lost their job, they're feeling jittery. 25% are feeling anxious, they're hanging on to their job but feeling anxious. 29% are business is down, feeling anxious, and 33% are feeling confident. So we have 2/3 of the audience feeling jittery or anxious, and 1/3 feeling pretty confident. It's good to know. Thank you very much for participating. Okay, so let's go on to the next round of questions. Again, Nilesh, I'll start with you. You have many hats on. One of the ones that you wear is being on the Economic Advisory Council to the PM. And therefore, I assume you have a ringside view of what's going on. what is going with the pandemic? I understand none of us are experts in that, but the economic impact of that, how do you think the government is assessing as it develops? And how do you think what the real situation is like? What do you see?
So it's now almost 100 days into the pandemic and few trends are visible. Bharat or rural India is doing pretty well compared to urban India. In FY21, Bharat can post positive growth, unlike urban India, which will have to post negative growth. If we look at rural economy, cement sales, two-wheeler sales, fertilizer sales, Rabi season output, Kharif sowing, all numbers are pointing towards positive growth. The effect of pandemic is not much felt in rural India. In urban India, April and May were washout. We did see IIP coming down by 55%. However, from June, July, things have started improving. So second week of June was better than first, third week was better than second, fourth was better than third. First week of July was better than fourth week of June. In second week of July, either because of rain or bunched up demand getting out, things have started stabilizing. Overall GDP growth this year could be -5%. This is the first time since 1980 that GDP growth will be negative. In this dark clouds, there are some silver linings. India will become current account surplus this year. In the month of June, we did witness, after some 18 years gap, first month where we are current account surplus, lower oil import, lower gold import, and hopefully lower trade deficit with China will ensure that we have current account surplus in FY21. The economic package announced by government and RBI should start building a platform on which FY22 GDP growth could be upwards of 8 to 10%. The beginning has been made, but obviously it requires execution all the way forward. Monsoon has been pretty good. It's above average. And we do believe that the world will now look at India favorably vis-a-vis other parts of the world, especially China. China is seen with eyes of suspicion. They are exporting Wuhan virus to the world. We are providing hydroxychloroquine tablet. And hopefully when vaccine is discovered, with 60% vaccine manufacturing capacity in India, we'll have a role to play. Now, this goodwill needs to be converted into foreign direct investment. And if we can become part of global supply chain management, then there is a probably multi-decade growth visible for India. In chemical industry and in contract manufacturing space, we have already started seeing global inquiries coming for Indian companies. This is similar to Y2K opportunity for IT industry, where they delivered good work on Y2K and slowly get into global infrastructure management or global IT services. So overall, FY21 will be negative, first time after 1980, but the bright spot will be rural India. And if we get our act together on economic package and foreign direct investment, and a glimpse has been provided by Reliance Industries Limited, how one can market India to raise capital from overseas investors, I think we have a decade of growth opportunity, which we have never witnessed in the past.
But before we get to that, I mean, that relies on quite a few ifs, right? If we are able to transfer the goodwill and be part of supply chain, if we're able to do a lot of things. As you said, it is the first time we'll see negative growth in our sort of adult life, right? I mean, I'm assuming we're similar age. So we came of age in the 80s. Some people have never seen those downturns. So what would you advise to them? How long will this pain last?
So unless until we have a durable medical solution, there's no way to identify where economy or market will bottom out. Are we going to see W-shaped things where we brought the infection down through lockdowns, shutdowns, and then when we open up, things starts, rapidly spreading? Again, we go to lockdown. Or are we going to see a medical solution either in form of combination of drug which can treat patients or vaccine which can prevent occurrence of coronavirus? Then normalcy will return and economic activity will resume. So a lot will depend upon medical solution. Now, today there are more than 8 vaccines which are into phase 2 trial, and they are moving into phase 3 trial. Moderna's vaccine will begin on 27th of July. So there is hope, but there is no certainty. And till such time we get medical solution, we have to live with the virus. We have lived with the virus of AIDS, for which no vaccine has yet been discovered. The same way we'll have to live with coronavirus. And there will be ifs and buts, because a lot will depend upon how we convert this opportunity for ourselves. Let me give you a very small example. There are 2 tiles company. One company took the challenge and moved part of its supply to rural India. They cut their advertising budget. They cut their staff salary. They deferred incentives. They have kind of negotiated rents of their showrooms and so on and so forth. And effectively, even though their sales have plummeted in June quarter, by and large, they are able to manage the downturn. It's not that they have not been impacted, but the effect is minor. They can withstand it. On the other end, there is another tiles company which probably took these steps after a little bit of delay. Now, for them, June quarter has been painful. I hope and pray that they will take corrective actions in July, August, and they'll be back on their feet in September. But essentially, what companies are doing in terms of cutting costs, individuals also will have to do that. Undoubtedly, this is going to be a painful period. But if we survive the downturn, then there will be great opportunities once medical solution is found.
Okay. And we are privileged enough to obviously be doing this webinar, and we're invested in the markets. So we have that as a secondary source of income. Markets have been, after sort of falling down, they have been running ahead. Can you explain to the layperson what is the link between the economy and the markets? When the economic situation looks so bad, why are the markets running ahead?
So in some sense, markets are looking forward. At this point of time, market is discounting that India will be current account surplus. Economic and financial package announced by government and RBI will have its effect on the ground. India will get FPI flows because MSCI and FTSE both are proposing to increase India's weightage in the emerging market index. Medical solution is round the corner based on phase 2 trials of 8 vaccines. So somewhere market has factored in certain scenario. Now, if actual scenario is worse than what market has factored in, markets will drop. If actual scenario is better than what is priced in by the market, market will rise. Second, there is a sharp polarization in market. And I'm giving numbers from my memory, so I could be a little bit here and there. But when you looked at Nifty on 30th June, it appeared at 10,302. The top 15 performing stocks of Nifty were trading at 13,890 level. And the bottom 35 stocks of Nifty were trading at 7,498 level. Now, we are looking at Nifty at 10,302, but it's driven by just 15 stocks. The rest 35 are dragging it down. And in fact, if you see the journey of Nifty from 7,600 to 10,500, 60% of it is driven by just Reliance Industries Limited. So this is a very sharply polarized market. Few stocks have done well, others haven't done that well. And one will have to be, that's why, very, very careful in picking up right quality stocks.
Okay, interesting you sort of say about picking quality stocks. Let me bring you in, Pratik, now. You are heading the index part of the Motilal Oswal business. So I'm assuming you've, I guess, put your weight behind the index business. Can you shed a bit more light about what it is that, who are you trying to aim at? And would you recommend that investors go to an index fund completely? Are you basing it on any research you've done? Or what is your view on that?
Yeah, sure. So, yeah, so typically I look at all our index funds, ETFs, as well as our international funds. So typically when I look at index funds and ETFs, I normally divide into two parts. One is the domestic piece and one is the international piece. So the international piece has actually been pretty much, I would say, popular amongst all investors across all groups. So, we have two of the best indices in the world, the S&P, the NASDAQ. And obviously the NASDAQ is built upon hard work put in by Anubhav out here. So I do think that the international is something which is, I would say, popular across all investor spectrums. We are advising all our investors to have a minimum of 10 to 15% of their corpus into international. So that is across age groups. The domestic piece is obviously a lot smaller than the international piece, and that is typically driven by a lot of these younger folks, the digital DIY guys who are investing through direct plans. So obviously, because of the low commission nature of index funds, it is not really popular with the distribution community, but we have seen really good traction. In fact, the number of transactions that we get on a daily basis is actually more than what we expected when I started. So I think that's how I would sort of divide the two businesses. In terms of, how I think this is really applicable for India, especially, I think we're not really fighting between active and passive. I myself is a believer of alpha and everything. It's more about simplicity in the investment landscape. Today you have thousands of mutual funds and you have another thousands of other vehicles, acronyms such as AIF, PMS, etc. So I think what index funds does is born more on the lines of bringing or reducing complexity as opposed to doing anything else in terms of risk return analysis. So I think that's where we come in. All our funds are pretty simple and easy to understand, and a lot of folks who don't really have the time to really go out there and try to find the right pick or the right fund, I think they're pretty much happy with what index funds do. So that's where I think we are positioned in the marketplace. Yes, in the West, the passive funds have proven to be pretty popular, and at least incrementally, you're seeing a lot more flows coming in the more the passive route. But I think it's still for that to happen. Obviously, it takes some time in India. We obviously we see opportunity in alpha, but we also see as a simplicity more than anything else strategy.
Okay, great, thank you. Anubhav, let me bring you in. There are a couple of, I guess, points that these gentlemen have raised. One is obviously the markets being polarized and only a few stocks are actually running ahead. So there's a whole active passive sort of question. And then also the question of domestic versus international. It would make sense to diversify internationally, and you were instrumental in launching that. But as Nilesh said, we need capital. India is capital hungry as well. So how wise is it to be recommending to invest overseas? Your comment on both these points, active, passive, and domestic, international.
Well, on the active passive side, I think that jury is no longer out there. While you do have information asymmetries in India and analytical asymmetries, I think over a period of time, those will go away, right? So whether you like it or not, this whole ETF business is going to be around for a while. And what has happened in the West specifically is you've had these two, shall we say, extra streams that have come out of this whole passive business, since S&P and iShares / BlackRock launched it way back. And the first one was your factor investing. And this is something I'll be talking about next week on another webinar. And the other bit is something called ANTs, which is active non-transparent ETFs, which is effectively nothing but your standard active mutual funds that are getting listed and traded. And investors are actually quite happy with the lack of information on those, and they're quite happy to trade them as well. So those are bringing in some interesting aspects to how you look at passive versus active in those kind of debates. Right? Understand one thing, irrespective of what we are doing, the advantages of computers being used by human beings to put out thematic funds, whether they're ETFs or mutual funds or any of those things, is significantly more efficient than what potentially you see in India today. And one of the reasons of not doing something like that, we've seen clearly in that entire fixed income credit space. where we just had these, it's unheard of. You have AA rated securities that go illiquid anywhere in the world, but even the banks are not willing to bail out those companies. So that's on the active versus passive side, a little complex. Like Pratik said, it's a very, very simple way of investing. You see the Nifty every day in your newspapers and your television sets. It's simple to understand. If you want to buy the Nifty, you just go buy the Nifty ETF and be done with it. Similarly, on the the international diversification, absolutely you need a counterbalance to India. And today we do have a bunch of international funds, ETFs available that people can invest in. We have the US and we have China today. There are a whole bunch of other active funds that are available from Brazil and a bunch of the other places, should that be of interest. So that is on the what is available. I think the important thing to understand out here is, and again, Nilesh is very, very succinctly described what we are headed towards. And my view on that entire situation is, if you are going to go down that route, why not take advantage of it? And this is not some unique insight that I have. This was, these are thoughts that have been propagated by the likes of Jack Bogle and a bunch of others over a longer period of time. If you were to do a proper asset allocation, and so long as your correlations have not broken down, and they have not so far, notwithstanding the odd spikes and the odd movements that you see in gold versus US dollar, INR, and NASDAQ, and the rest of it, you can take advantage of that volatility, making it work for you, right? You don't need to, one fine day if the Nifty, goes down 5-10%, the last thing you want to do at that point in time is dump the stock. Because if it's Nifty and you've got that, as Nilesh put it, you've got that 10-year growth ahead of you, that is the time you take advantage of it and just rebalance your portfolio. And by rebalancing, I mean it in the ETF sense of the word and not what our IFAs understand in India. It basically means that if you have a 30% or 50% or a 70% allocation to that Nifty component, you bring it back to that component in your portfolio, which also then means that you are going to end up buying something, selling something that has gone up. So once you're constantly booking profits and buying things that are low, your portfolio will by and large ride north of whatever the market does by investing just in the market, right? The other thing that it does is it takes all the passion and you basically get into a dispassionate way of investing. You don't react emotionally to your portfolio and stop taking decisions based on panic and euphoria that, one of my earlier mentors, Mr. Ramdev Agarwal, has always warned against.
Right. So a couple of issues that got raised. One is, I guess, the preference for passive is more a simplicity argument, which I must say, even I agree with. But when it comes to investing in, say, fixed income, the case for passive is not as clear cut. Usually, I mean, the higher the market cap, the more allocation in the index, and therefore you can invest in it. And lucky for us that the large cap stocks have been actually doing well. The small caps have not been doing so well. So therefore the index investing has worked in equities. But for those people who need income and have gone in looking for debt funds, is it wise to invest in index type strategies? If not, we need to go active. But when we go active, we also have had an FT, Franklin Templeton type situation happen. So Anubhav, first your view on fixed income ETFs, and then Nilesh, I'll come to you about on that as well. Anubhav, firstly, what do you think?
All right, so let me get into the case for fixed income ETFs. Now I've done a bunch of studies on this across the spectrum, including having launched sort of a one of the first quasi fixed income products in the past. In the last financial crisis that is done and dusted now, and we have a 6x6 hindsight into the whole thing. When the yields crashed from 9.5% to 5.5% back in 2008, right? Your 10-year benchmark GSEC returned around 40-something% in that one scenario. It was obviously the market thing. And other than, funnily, there was the Kotak fund that was there. With that one exception, the entire bunch of fund managers, active GSEC and fixed income fund managers, grossly underperformed that index. which means that there is a case for passive fixed income, right? But then that is a very, very broad term. Again, as I mentioned earlier when I was talking about my own portfolio and so on, if you're looking for a regular income, attempting to put that regular money, which basically means your house rent and your child's fee and groceries and all of that at risk by exposing your portfolio to market risk, is probably not a good idea, right? That regular income then needs to, that regular income bit needs to be handled like a retirement portfolio when you've already retired. So rather than using a regular income coming out of an asset allocation or those kind of things, you keep that money aside. Having said that, let's assume you have retired and you don't have an income today and you do need to withdraw from it. I think the reverse of using cash flows to rebalance your portfolio should be done to get money out of the portfolio, which is like a quasi self-engineered systematic withdrawal plan. Whereas after every withdrawal, your portfolio gets rebalanced. By that, what I mean is that if you have, 20% allocation to fixed income in your portfolio today, after that withdrawal, it should go back to 20%.
Yeah. Okay, that's easier said than done. But also, indexed fixed income strategies rely on credit ratings. And I don't know about how you feeling confident about credit ratings done by these agencies. I'm not. And I think the last crisis, if anything, showed that they were not to be relied on, which is why I would trust a fund manager to go and second guess the credit rating agencies, which leads me now to how good are the fund managers in actually managing fixed income. Nilesh, let me turn to you. What do you think happened with Franklin Templeton? Was it a manager issue? Was it a COVID issue? Or was it a risk management issue?
See, they are my competitor and my ex-employer as well. But dispassionately, when I look at it, I think they were following a strategy of high risk and high return. In COVID-19 era, where liquidity disappeared, especially at the high risk end, running an open-ended debt fund would have created its own issue. I'm not privy to much details on their instruments and structuring behind it, but clearly April 2020 and March 2020 were 2 months where even AAA rated papers were finding it difficult to be sold at market yield. You were always hitting the offer side. You were always hitting the bid side rather than the offer side. But just bringing together, whether an active fund or index fund, the investor has to invest only if it's value accretive to them. If active fund managers are not able to generate alpha over a cycle, not necessarily every day, every month, every quarter, but over a reasonable period, then there's no point in investing with them. Then you might as well give money to index fund managers because they will at least try to mimic index. Now, whether it's equity or fixed income or commodity, unless until we as active fund managers add value to our customers, we won't have a job. And either we cut expenses or we deploy certain tools like leverage, concentration, long short. But at the end of the day, active fund managers will have to add value to their customers to retain their job. Otherwise, index and ETF funds will take over them.
Sure. The issue, I guess, what I'm asking is, I mean, if it happened to FT and they were very open about their investment philosophy, why were they, one, I agree with you, because there were enough other managers who didn't apply that philosophy and they were very conservative. So this was obviously their choice to have made. Having said that, where were the rating houses assessing that risk? And where were the advisors also understanding that risk and advising their investors? So my concern is not that one manager chose that investment philosophy. My concern is there's not enough good research out there on mutual funds, independent mutual fund research on mutual funds. And perhaps there's not enough understanding, education amongst advisors and investors on what these risks mean. So when someone rattles off mutual fund sahi hai or mutual fund are subject to market risk, blah, 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 everyone knows this line. I think the investor awareness program that AMFI has done has been excellent. but only as awareness in terms of someone being able to repeat that line. You ask them, do you understand what that means? I am at the moment I'm mentoring 10 interns who are studying finance. They've already been through CFA level 2. Actually, not CFA level 2, but some on MBA finance. And when I ask them, do you understand what this line means? They have no clue. So what I'm saying is, I think, I don't know whether it's Amphi's role or who else takes this on, but there certainly needs to be better research, more research. Firstly, Morningstar and Value Research are not enough. I think we need more, many more, hundreds more. And two, we need much more education as opposed to just awareness where people just repeat. What do you say to that?
Undoubtedly, Hansi, as industry, we need more educated and informed investors so that they can withstand the cycle. At the end of the day, it is in my selfish interest to have informed and educated investors. If they don't make money, I can't make money. So our interests are aligned. If my clients are richer and wealthier, then only I can charge fees to them. And that's how I can sustain my business. Now, many a times fund delivers performance, but the same performance is not shared by investors. This is globally true, not only in India. Now, how do I break this cycle so that investors' returns and funds' returns are in as much alignment as possible? This can only be done by keeping investors informed and making them educated. Now, there are 2-3 ways in which it can be done. One, I take the task of educating all the investors. Now, you correctly have stated that even people who have got formal education and who are just passing out, they don't have real world experience. So this will be an impossible task, or it will take too much of time. The second is to create this intermediary who themselves can then reach out to customers and make kind of force multiplier effect. And this is where we are focused upon. In terms of transparency, mutual fund industry is one of the best, and yet we are improving. So for example, we got a feedback that, look, when you're putting duration of the portfolio, we didn't understand that this was mainly to measure interest rate sensitivity. We actually started thinking duration as maturity of the portfolio. Immediately from 31st July, you will see maturity being disclosed separately for all fixed income funds. So this is step by step. You could always argue that why didn't we think about maturity earlier? Well, past is past, it can't be undone. But in future, we will ensure that people have more data points so that they can take informed decision. The second step where we need help from outside of mutual fund industry is actually deepening of bond market. On equity side, we have created fantastic cash market, derivatives market, options market. It's still improving, but we have whatever we have done, we can legitimately take pride in it. Unfortunately, on the fixed income side, beyond government securities, we haven't created derivatives market. There's no interest rate futures market, which is liquid. There's no interest rate options market. Globally, fixed income market is multiple times equity market. In India, equity derivative market is hundreds of times more than the fixed income derivative market. So if we get regulatory support for deepening of bond market, we continue our journey on educating our advisors, which in turn can pass this message to the investors and create a force multiplier effect. We also take advantage of media like Deccan Herald in reaching out to customers through this kind of webinars. Over a period of time, we will move the scale. Can I make every investor financially literate in true sense overnight? Answer is no. This is a journey where we'll have to continue, keep making the progress.
Okay, thank you. Let's go to our second poll of the session. Can we bring that up, please? Okay, the question is, after hearing this session, how confident are you feeling about riding out the economic downturn and market volatility? First answer, pretty confident. Second answer, need to fix a few things. Third answer is still in wait and watch mode.
So meanwhile, Hansi, as the people vote over this questionnaire, on this poll, we have a lot of questions coming from our audience, both on YouTube as well as the Zoom. So would you like to throw open the floor for questions and take some questions from the Zoom platform?
Of course, sure. So look forward to your questions. Should I go to the chat or the Q&A? There seem to be many.
Both. Some questions are coming up in chat and some on Q&A. Let's start with the Q&A part first, then go to the chat box.
Okay. On the Q&A side, the context of preparing for such uncertain scenarios, other than mainstream income from either salary or business, what are some possible income streams one could consider? Do any of you want to answer that? Pratik, do you have a view on this?
Yeah, sure. So basically, I think, sorry, let me just go to the question.
How do you create income streams, basically?
Yeah. So in terms of income streams, I do think that people should ideally have higher allocation to, say, liquidity today, because the demand for liquidity is a lot higher because obviously unforeseen expenses that might happen because of the COVID situation. So I do sort of push investors to have a slightly more allocation towards more cash or liquid segment. But, I think at least from what I've learned, ideally, what there's a saying, when in terms of for investors, returns decrease as motions increase, So ideally, I think, investors ideally should not make a lot of changes to their portfolio. Ideally, I think the reason why a lot of people have this gap, it's called the behavior gap between returns, investment returns versus, I think your portfolio returns, is because people tend to be conservative during bad times and aggressive during good times. Which is exactly not a very good recipe, ideally, because you should ideally have the same risk profile. You should have the same, I would say, asset allocation in good as well as bad times, because ideally, by being conservative in a bad time, it's like basically buying insurance after your house is on fire. So I do think that, investors ideally should obviously have a higher component or a little bit more liquidity than they would otherwise had. But to the portfolio itself, I wouldn't recommend any changes. Ideally stick to the same. Make sure that if you are aggressive, stay aggressive. If you are conservative, stay conservative. Because if everyone's buying balanced funds today, or maybe a hybrid funds or whatever it is, when the recovery happens, people will be disappointed at some point of time. So that would be, my at least my 2 bits on managing finances in this sort of a situation.
Yeah. Quite a few questions are actually coming up on this theme of income. And so one is on, we don't have social security or any free advice to help us, lost medical insurance too. So which bank is the most safe for FD? Is it safe to put some money into FMCG, and which one would you suggest? And then there's another one on, I've invested in DHFL FD. Do you think I'll get back my investment? Which kind of leads me to, I guess, a similar question to what I was asking. I mean, imagine how difficult it is to pick mutual funds when there are many securities in the portfolio. People are picking FDs of individual companies. Anubhav, Nilesh, do you have any comments on that? What would your advice to them be?
Yeah, I think the first thing is that if you are getting that pretty high rate of interest, there's no such thing as a free lunch. You are taking risk. Invested into the DHFL bond or the FD at the rates that you got into, were probably in double digits when the bank deposits were in single digits. So that risk is there. Right? The idea would be, if you can do that, provided you have a whole bunch of stuff on your fixed income, including the FD portfolio, on maybe something that is a little less risky. Right? Maybe with one of the bigger banks, or some government bonds, or some RBI bonds, or some tax-free bonds, or any of those. Right? So when you look at it, within your portfolio, you still need to diversify some of that risk. I think Nilesh had mentioned this about duration a little while ago. So you should have a mix of durations in your portfolio. You do need to have a mix of maybe credit risk in your portfolio as well. But at the end of the day, buyer beware.
Right. Okay. Continuing on the similar theme, in these times of uncertainty, Mahesh Chand TN, sorry, I should be reading names out. Sorry about that. I will try and read this out now. In these times of uncertainty and low interest rate, what is your opinion on guaranteed maturity products from insurance companies which are tax-free in nature? Nilesh, I mean, as Amphi, you represent the mutual fund industry, but we always get compared to the insurance industry, and they do have the advantage of being able to offer a guarantee. Your views?
So again, when you look at guarantee, please remember that there is no free lunch. People are going to charge for that guarantee. There's no charity in public life. So when you're looking at insurance, please be aware what is the premium they are charging for providing that guarantee. Now, I'm not referring specific to any insurance policy, but I do remember reading some time back where a particular product was offered, where first 20 years, they had not calculated any return. And from 21st year onwards, they were paying a reasonably large sum of money. And it was positioned as if you invest 1 lakh rupee, and after 21st year, you take 1 lakh rupee every month, something like that. Now, for a common man, this will look like a dream come true. I invest once, I forget it for 20 years, and then I get a good return. But when you calculate the IRR was calculated some 4.5%. Why don't you invest in government securities, which was giving you 7% return at that point of time? So please remember that there is no free lunch. When someone is providing guarantee, he will charge fees for that. If you manage your money carefully in a diversified manner with the help of a good advisor, the charges you will pay will be far less than for such guaranteed products.
Yeah, but they need to, I guess, learn to ride out the volatility. And I obviously think this bucket approach, where you put away one bucket for the long term, and you have this other bucket where you have enough money that you shouldn't need to touch the long-term bucket. I think that's the trick to being able to manage your personal finance portfolio. I know this Morgan Housel, who's a good writer in the US, he also writes about that. The idea is a barbell strategy of having a very long term and being able to ride it out. One other question that has come up, Anurag Srivastava has asked on YouTube, should we go with sovereign gold bonds or the traditional physical gold? And then also any equity or specific sector funds which can be invested for the long term, 10 to 15 years. So on one hand, gold, and second hand, 10, 15 year horizon. Nilesh, any questions on any?
So let me answer the gold part. When you buy physical gold, many people don't know whether they are getting the good quality gold or not. To a great extent, this problem has been sorted out in urban India, where keratometer is available, hallmarking is available. But in rural India, in semi-urban India, quality of gold remains an issue. The second thing is that, when you buy gold in smaller quantity, 1 gram, 2 gram, 5 gram, 10 gram, you end up paying a huge premium. You sometimes end up paying 15 to 30% premium to buy gold in smaller denomination. That's a huge cost. Third, many women do wishy kind of things with jeweler, where you go to your roadside jeweler, you deposit money for 11 months, and 12 months, the installment is paid by the jeweler, and you get option to buy a jewelry at the end of 12th month. Now, we have seen in Mumbai, in suburban Mumbai, a jeweler disappearing called Goodwin Jewelers with some 200 crore rupee. Now, imagine the loss which these poor housewives have got. And this keeps on repeating in every nook and corner of the country. Now, these are the perils of buying physical gold apart from safekeeping and security. Government has done a fantastic job in issuing sovereign bond funds, sovereign gold bonds. You get 2.25% to 2.5% interest over 5 to 7 year horizon, and you get price appreciation of gold. So anyone who has a 5 to 7 year horizon, he should be definitely looking to invest in sovereign gold bond over physical gold.
But you're right. But doesn't that financialize the whole point of buying gold as a real asset? Is like buying real estate as a real asset, then buying REITs or a gold ETF or a sovereign bond. Doesn't that kind of defeat the purpose of actually having something tangible that you can put on you and travel anywhere you want?
I wouldn't say so. Your point is absolutely valid on a theoretical ground, no difference of opinion. But if on a 5 to 7 year horizon, can I take a call on Government of India to honor his commitment? My answer will be yes. Now, if we go into Yemen or Syria kind of situation where government doesn't exist, then certainly having physical gold is far better than having a sovereign gold bond. But bearing those exceptional circumstances, I think getting 15% return on a 2.5% into 7 year kind of thing, it's far better. There is one more reason why you should be looking to buy sovereign gold bond rather than physical gold. Today in India, we have 12.5% import duty. What is worth 100 rupee gold in Dubai, it's 112 rupees 50 paisa in India. Now, when you're buying gold, you're already paying 12.5% import duty. You're already poorer by 12.5% compared to global price. Might as well get this coupon and compensate that loss.
Anybody else has any views? Anubhav, you have any views on?
So let me quickly add to that. The points that Nilesh raised are exceptionally valid. I would like to bring in the little bit about gold ETFs out here. This obviously assumes that you have a demat account and you can actually have a trading account and you can actually buy gold ETFs. These smaller denominations are what you can buy in the gold ETF. I think the lowest denomination ETF is some 20-something rupees, 40-something rupees today. Right? Now, what that does is it actually gives you an exposure to a kilobar equivalent, which means a large quantity of gold, but at a very, very small unit. And that 1% per year that you pay in terms of fee to the manager or whatever that amount is, actually disappears in the differential that you would ordinarily pay for buying the physical. Right? And without any quality issues, because all of the gold practically that is held in the vaults that is backing all these gold ETFs is 995 LBMA good delivery international quality gold that is not manufactured by your local jeweler. Right? So if you want now, one of the disadvantages of your sovereign gold bond is that at least today that there doesn't exist a liquid market for selling that. So a sovereign gold bond is not necessarily such a great addition to your asset allocation strategy, but a gold ETF or a gold ETF plus a sovereign gold bond strategy might actually do the work for you. So let's say today, if you think that you're into a risk off mode and you want to increase your allocation to gold, then you just might want to take a mix or just buy the gold ETF and keep rebalancing it, because that gold ETF is fortunately very, very liquid.
Okay, so we have a panelist, Uma Pai, who's saying, hi, good evening. Which safe investment would you suggest for me? I'm only 74 years old. And then we have Raghunandan, who's asking something similar. He's 22 years old. So we have quite a mix of an audience. Pratik, maybe you take the 22-year-old. What would you recommend to a 22-year-old? And then we have to figure out who the oldest is here before we take the 72-year-old.
Before we move on, Nilesh, he has some call right now at 5 o'clock, because this we might have a spillover of the discussion. So Nilesh has a call right now, so he might have to leave right now. So probably we can have the poll results.
Oh yeah,
in front of Nilesh only.
Yeah, let's just
thank you.
Poll results. Okay, I'm going to read this out. 16% are saying they're feeling pretty confident. 36% say they need to fix a few things, and 49% still are in wait and watch mode. So I don't think we've done a decent job, but we've not done that great a job. But my humble suggestion to the audience would be that it's very hard to do a proper sort of session in that limited time frame and this format. May I suggest that you keep up? Thank you for coming along to this thing, but also keeping up your educational journey. And Nilesh has promised that he will put more effort into education. So I'm going to go and pitch him some ideas of how to do investor education better, because I believe everything that is being done so far is good enough. But anyway, but thank you so much for your time, Nilesh. If you are leaving.
Thank you.
Thank you. And all the questions that have been marked to you, we'll pass it on to you later.
Yes, Pratik and Anubhav is there. So.
Okay, great. Thank you, Nilesh. Thanks.
Thanks, Nilesh.
Okay, so Pratik, you are answering what
Yes.
is your recommended portfolio for a 22-year-old?
Yeah, so is this on a low risk sort of portfolio or portfolio in general?
He's 22 years old. Okay, so here's
Okay.
the other thing. I believe there's no such thing as a risk profile. I have not led,
Okay.
I mean, I know every regulator mentions it and every textbook refers to it. But in my search in the psychology literature, there isn't anything. I mean, hell, even the IQ is being questioned whether there is such a thing and whether the brain is in fact elastic enough to learn. So what I'm saying is, I think that the industry saying that there is such a thing as risk profile, answer these 6 questions and thou are conservative or aggressive. I don't believe in that. I believe in educating. So imagine they're 22 years old, they're a blank canvas. What would you say to them?
Yeah. So just to give a point on the risk profile section, I actually don't disagree with you. It's just that, when you don't have a risk profile, you tend to, as I said, be a lot more aggressive. So when everyone's making a lot of money, you tend to also go inside the markets and try to make money. I mean, no one's making money, you tend to stay away from the markets. So I think what a risk profile does is actually gives you an element of discipline. What we've seen is that people who don't have consistent risk profiles end up not only making a lot of money over the long run, because they end up taking risks when they're not supposed to, and they don't take up enough risk when they're supposed to. I think that's where at least my stand is on risk profile. But yeah, I agree. I think most investors, the problem is they don't end up following the risk profile needs, which is why I think, as you said, education is extremely important. But to a 22-year-old, I think the number one question, at least when I was 22 years old, I think is, should I go into should I go and open a stockbroking account and trade stocks as opposed to investing in mutual funds? I do, at least I've seen that just how smoking is bad for your health, trading is actually bad for your wealth. I would discourage people from actually putting large sums of money in trading. So stick your money, so I think money in mutual funds is something which I really sort of advise. Have a diversified mutual fund strategy. Don't tend to hold any sector or themes, because they tend to become very risky, don't really give you that much diversification as you think you are. And also have an asset allocation strategy, where you are. So the reason why asset allocation is taken off in a big way is because people have realized the reason why asset allocation has become a gold standard is because people have realized that, market timing does not work. You have to spread your bets in 3 or 4 different asset classes, because you don't know what will do when at all times. So I do think that a 22-year-old should ideally have, say, I would have maybe 50 or 60 or 70% of my money in equity, have that between, say, domestic or international, and then have the rest of the portion, say, debt or even gold. So a combination of those 4 asset classes is a great strategy. Make sure you rebalance your portfolio every year or so to make sure that you go back to your initial asset allocation which you started with. And don't listen to your neighbor, don't listen to your friends. Make sure you have this strategy and stick to it, because there'll be a lot of people coming to you and selling you products when they're not supposed to. So I think have a strategy, have a low-cost strategy, and stick to it, and you should be okay.
You remember when you were 22 years old, there's no way you can not listen to your friend. I mean, you have to listen to your friend. So I don't know about that one being working. There's quite a few more questions on the buckets in terms of what if we only had 2 buckets, or how to divide the bucket and stuff. So if I may sort of summarize what we have discussed, because it's 5 o'clock and we have to wind up and we can't take all the questions, is that notice that Anubhav, you also referred to buckets, and Pratik, I think you did as well. So while you're still going and seeing a financial advisor and seeking professional advice to get started, it is best to divide your wealth in 2 to 3 buckets: low risk, market risk, and kind of high risk, high return. And it's okay to intuitively divide that and know that, okay, this low risk one, I cannot afford to lose. The middle one is put away for the long term, and the high risk, high return, yes, if it pays off, it can get me to the next strata of society, as in a new startup idea or things like that. But if it doesn't pay off, I should be able to walk away from it. Something as simple as that. And then within the market bucket, definitely start with index funds or ETFs to get started. That's the simplest way to get started. And my suggestion would be, as you learn more, come along to these webinars more, look at more, read some good books, then you can build up your knowledge and start selecting funds, and then also start selecting stocks when you understand what they mean by investment philosophy, how they expect those funds to perform, and so on. That would be my advice. Hopefully that means that you're feeling more confident after this. I would thank you very much, Anubhav, for making the time. Thank you very much for your insights. And Pratik, yours as well. Thank you so much. Over to you, Furkan.
Hansi and Furkan for organizing this. It was a pleasure.
Thank you, everyone. Thank you, Pratik. Thank you, Hansi. Thank you so much for moderating it so seamlessly.
Thank you. I hope
thank you so much.
It's my first time. So in case I was looking here and there and everywhere,
thank you so much.
I was trying to manage all of it. Thank you so much.
Thank you so much.
There's a few more messages coming. Sorry, we weren't able to take all of your questions and or read out your names. I'm available on all social media as The Money Hans. So if you want to put it to me, feel free to. Same with Anubhav. I think his Twitter handle was on the social media. And Pratik, I think you're on Twitter as well, right?
Yes,
and so is
yes.
Nilesh. Nilesh has a good following. So I would say, in case there are any questions, feel free to follow us and put questions onto social media. Thank you very much.
Thank you so much. Thank you, everyone. Thank you, viewers.
Thank you.